Aloha, Facebook friends and fam. I'm Crystal Cabansag with Coldwell Banker Pacific Properties. As a real estate agent, a question I get a lot is how's real estate? Up until a few days ago, I couldn't really answer this question as well as I normally can or I'd like to, so I spent some time doing research to better understand the impact of COVID-19 on today's real estate market. While it's hard for anyone to predict the exact future, here's some key differences between 2020 and 2008 and why it's possible, it's possible real estate will make a V-shaped recovery on the other side of COVID-19. Number one, market conditions. Nationwide, in the 6 years preceding the housing crash of 2008, the prices of homes were overinflated and people were buying and borrowing beyond their means. Starting in 2005, the 2.5 to 3 years preceding 2008, people were given loans without any income or asset verification being done, and sometimes with no down payments required. That means that if Ted wanted to buy a home, all he had to do was say he wanted to buy it. He didn't have to show proof of income, proof of any sorts of assets. He didn't even need a down payment. Today's buyers are more creditworthy due to the stricter underwriting requirements, which occurred after the 2008 crash. They have to have their incomes and assets verified, and you also need a down payment. Another thing is the government stepped in with the CARES Act, and because of the forbearance options offered to struggling homeowners, you won't see massive defaults leading to foreclosures like you did in the crash of 2008. Others also speculate that due to the unemployment benefits, combined with the furloughing of workers when possible rather than a complete layoff, this added another layer of stability to the market that was not previously there in 2008. Sorry, this is the first time I have charts and I'm doing a Facebook Live, so let's see how this goes. If you'll note, and now I can't point to them. Hold on, let me see how I can do this. Okay. So annual home price appreciation. If you'll note, in the 6 years leading to the crash, home prices were up 8.6, 6.5, 8.5, 8.7, 12.5, 11.4%, meaning the values of the homes went up every year. They were overinflated. Look at these 6 years leading. More reasonable, 4.4, 5.2, 5.5, 6.4, 4.8, 4.7. So you can see overall there's just a big difference in the 6 years leading up to the housing crash. Also, the percent of median income needed to purchase a home, say starting back in 2006, was 25%, 25.4%. And now it was 14.8%. So you can already see right there that those market conditions are very different when you compare 2006, 2008 to 2020. Also, here's another interesting chart that I have. If you look at the amount of home equity that people were cashing out previously, in the 3 years leading up to the crash of 2008, you see that they cashed out a total of $824 billion, as opposed to the 3 years leading up to 2020, $232 billion. So 25% less people are accessing their equity lines in their homes. And let's go back, sorry. Okay. The next difference is lower inventory. Inventory was much higher in 2008 when compared to today. If you look at this chart, can you see that in 2007, there were 8.2 months of inventory remaining on the market. That means if all active homes were sold in 2007, it would take 8.2 months to get rid of all of them versus 3.1 months nationwide today. So your inventory is much lower. As you know, when you have less of a product, you have more of a demand. So less supply equals more demand. The other difference is you have historically low interest rates. I'm gonna look at my notes. I'll do my best to explain this, though I'm not an economist, nor do I hold a finance degree. But I did spend a few hours talking to different experts and watching different videos. Once COVID-19 occurred, businesses, small, medium, and large, started to be affected by the shelter-in-place order. Their revenue streams dried up. they decided to access their lines of credit at banks in order to try and stay afloat and take care of their employees. This led to a liquidity crunch. Meaning, what does that mean? Banks had less money to lend to investors who also sometimes borrow money to buy mortgage-backed securities. What does this have to do with anything? Why am I telling you about this? If you're like me and you remember hearing interest rates temporarily spiked after the Fed slashed the federal interest rate to 0%, this is why. Less demand for mortgage-backed securities and more supply of mortgage-backed securities led to higher interest rates. That's why a couple weeks ago you saw a spike, even though people were expecting interest rates to drop after the Fed's slashed the rates. It was a supply and demand issue. However, the government has since stepped in, restabilized interest rates, and they're now at an all-time historic low, 3.5%. In fact, I was just talking to my lender the other day, just for Ivan and myself, to see if we refied, and I found out that I could save like $531 a month just by refining and taking advantage of the interest rate. Okay, going along. Also, pent-up demand. We have all been indoors for a long time, and we've probably had a lot of time to be on the internet if you're not an essential worker and you're at home. And after we get through this hard time together, life events like weddings, births, children going off to college, funerals, and divorces will still occur, and these major life events are often the catalyst for people who need to buy and sell their homes. So going back to why it's possible that the real estate market might do a V-shaped recovery is 1, low interest rates, 2, low inventory, 3, more stable market conditions going into 2020, and 4, pent-up demand, like I just mentioned. Now, if you're here local with me in Oahu, I'll quickly go over how the Oahu market is doing and how this relates to you if you were thinking about buying or selling. Here we go. So if we're comparing 2008 to 2020, you'll see that for single-family homes, unit sales are up in 2020 at 303 compared to March 2008, 282. Median sales price is also up at 810,000 compared to 628,000. Days on market is down 15 days on market versus 2008. You had to wait 47 days on average for your property to go in. Inventory is also lower, as you can see, 1,227 compared to 1,918. The biggest one is months of remaining inventory. You'll see that there's only 2.6 months of remaining inventory for single-family homes on Oahu versus 11.8 back in 2008. Looking at condos, condos we have a little bit more inventory than we did, less. 2,274 as opposed to 2,581. Median sales price is up at 435,000 versus 329,000 in 2008. Unit sales are also up in 2020 at 410 compared to 392. The other big one, once again, that I kind of highlighted nationwide is months of remaining inventory are 3.6 for March 2020 as opposed to 8. You'll also see interest rates are 1% lower, so lower interest rates, lower inventory. This is kind of interesting. This is how many properties went into escrow since the beginning of the year. Now, the blue line is 2018 and the green line is 2020. Sorry, I can't see. Let's see. Week 1. So what about foreclosures? Oh, did I talk? Oh, how many? Well, there's actually the CARES Act. Lenders are not allowed to foreclose on you right now. I was speaking with one lender today. The rules are kind of, one concern is you don't need to show hardship for foreclosures. You can just say that you were affected by COVID, and a lot of companies, I think they're required, I could be wrong, to allow you to forbear for 12 months. But one interesting fact is you have these service providers, which are the go-betweens between like your mortgage lender and then the ones who sell the mortgage-backed securities. Last year they profited $10 billion, but Kevin told me that even if just 25% of people decided to forbear, then the service providers would lose something like $17 billion in a 3-month period, which could be an issue. It's hard to know. It could be an issue because even though they're not reporting, even though forbearances don't affect your credit report negatively, in 2008, 2010, they did write forbearance on your credit report, and so far there isn't guidance yet for lenders as to whether or not seeing forbearance on your credit report would look like a foreclosure. So it could affect your lending ability later if you do use the forbearance option. It's unclear. So that is a little bit concerning because it's a gray area. You would hope that with many Americans being in the boat, possibly of having to claim forbearance, that would not be a negative factor, but it could be, and it hasn't been clearly explained yet. Okay, let's see, turning around. Hope I kind of answered that, John. So if you look coming into the shelter in place order, you will see right here, this is like the last couple weeks of March, you will see that the amount of properties going to escrow started to level off. So you are starting to see a change. Lastly, this is a chart that one of my coworkers, Cynthia Pilkington and Shannon King, made. This is pretty interesting. This is very localized to the Kailua market, but if you'll see, I know you can't see, if you're comparing 2019 with 2020, up until the week of March 23rd, the properties going into escrow were pretty much the same, but starting the week of March 23rd in Oahu, in 2019, 105 properties went into escrow versus only 82. In Kailua, you had 6 properties go into escrow during that week versus only 3. So 50% less properties in Kailua going into escrow. And then if you look even at last week, this number is pretty eye-opening. For Oahu, you had 107 properties go into escrow in 2019 versus you only had 56. So that number is almost cut in half. And lastly, Kailua, ooh, you saw my messy kiddo house. Lastly, for Kailua, you had 10 properties go into escrow the week of April 1st, 2018 versus you only had 1 property go into escrow last week in Kailua. So 90% less properties going into escrow. Obviously, this is due to the shelter-in-place order. People are more hesitant to buy homes that they haven't seen unless they're an investor. You know, so it's good that people are staying safe and flattening the curve, but that is the trend you are starting to see, at least in the Kailua market. Anywho, I've done my best to explain a there are so many factors that play into how COVID-19 is affecting the real estate market, so I did my best to give you a comprehensive understanding. So if you have any questions, please feel free to private message me. Thank you for watching. I'm Crystal Cabansag with Coldwell Banker Pacific Properties.